system sustainability. They have to strike a balance between those three things, because we have to ensure that the contributions we collect is affordable, the benefits that we pay are adequate, and that in the process of doing both the contributions and the benefits, the system can be sustained in the long run.
Yeah, which makes sense, as in any business. I was asking earlier, how frequent is that review done? When is the next? When was the last?
Okay. Every 3 years, and from the inception of the program in 1976, the first one would have been done in 1979, and every third year thereafter, it has been done. The last one was done as at the end of 2023, so the next one will become due 26.
Okay.
Right? So they're not doing it at the end of the period, but they're doing it to assess the state of the fund at the end of that, as at that date.
Okay.
So they would not do it in December 2023. He would have done his preliminary, and we are right now deliberating upon the report of that last one, the 15th review of the system. So they would come subsequent to the end of the period, but they're doing the assessment as at the end of that particular year.
Yeah, Mr. Jean-Jacques, I'm not sure how detailed you can be right now in terms of the findings so far, looking over the years with, I know there has been migration, especially after the disasters and COVID-19. I'm sure that would have affected employment, to a certain degree, income generation to a certain degree. So how does that weigh in, that particular aspect of your research itself in terms of moving forward and all your assessments and calculations?
Well, I can't speak on specifics, but I can talk in general how those things affect an actuarial review. So when it comes to population, one of the things that's going to affect your forecast is whether or not you have an increase in population or whether you have an aging population. All of those factors related to population, whether you have net outward migration or net inward, they're going to affect whether or not we expect to have more of a surplus on the fund, or whether or not you expect a decrease in that surplus. So in general, we can say that as you increase the population, as you have more contributors, it's sort of like a family. If you have 4 people taking care of one parent, or it's going to be a lot easier than if you have 2 people taking care of one parent. So generally, as the population increases, you're going to have less burden per contributor, and it's going to be easier to pay benefits to people of pensionable age. And obviously the opposite is true if you have fewer people. So the disasters, for example, where you have more people leaving, or you have net outward migration, those things would make it more difficult in the long term if that trend were to continue.
And what has been the overall trend over the past 15, 18 years? I mean, Mr. Etienne and Mr. Jean-Jacques, for the longest while I've been hearing, if you go online, you see that the population of Dominica is $70,000 since I was in schools. 70,000 people, excuse me. I'm on money. 70,000. We know some people are coming in, and some people are moving out. But what has the stats shown with regards to the population and how this has affected contributions over the years, really and truly? Because I mean, I can be very blunt and honest. I don't know as a population. If someone asked me, what's the population of your country? I'm not sure when last a census was done, to determine where exactly we're at in terms of our numbers. But we're hearing that we have been on 70,000 people for so long now,
So the last formal census was done in 2011. One should have taken place in 2021. That I think it started. I'm not sure it has ever been concluded. And that in itself has implications for the actuarial assessment of Social Security. Because the previous review when they came for the previous review, they did not have access to updated population information, and they had to make projections on, they had to interpolate to make some projections. So to the extent that on this most recent review, the projections are a little less favorable than it was the previous time, because when they take the account of what actually happened with the population, it is not the population growth that was anticipated doesn't seem likely. And if the population is not going to grow, it means the chances of the system having a large pool of contributors is going to be compromised in the process, so that the projections going forward doesn't look as good as it might have been when they thought the population was going to grow. And the population kind of lingering among 70,000 has been like that for many decades. So you give and take, people come and
for almost 40.
For almost 40 years,
40
it has lingered
years.
around. And if you recall, we've done some reform measures, some reform changes, starting in 2012. So the fact that our pensionable age is now 65, the fact that our contribution rate has been increasing by 0.25% per year for the last several years, those became necessary because some of the assumptions on which the fund was established, when it started in 1976, it was known that the contribution rate that was being charged would not be sufficient to sustain the system for its lifetime. So that you start at a particular point, and over time you make changes to ensure that it remains sustainable. But what was happening is that those assumptions did not materialize to the extent they were initially envisaged to materialize. So population growth wasn't taking place. So if population not growing, the contribution base is also not growing, because the contribution base comes from the larger population. And you have increased migration, you have people having fewer children, you have people living longer, and all of those dynamics, all of those factors affect how the system is functioning and how the system is expected to continue to function going forward.
Mm-hmm. And has this have a more of a negative effect, on the system over the years? I know you just made reference to the increase in the contribution rate over the past few years.
Yeah.
But when we look at that, because you're into say other schemes such as the student loan facility, which we'll talk about in a bit, but does that have an overall negative effect on the DSS at the end of the day?
But the collection of contributions is contributions come from people who are engaged in employment. So if you have fewer people working, whether because there is not work to do or because we haven't got them to work, it means the contribution level is going to be affected by that. To the extent that the population can grow, you will have more people enter in the world of work, the workforce, and beginning to contribute and continue to contribute, even while you have some of us who are already in the system coming of age, where we now have to start drawing out our pension from the system. And these pensions are lifelong pensions. Once you qualify at the material time, the system has to continue to pay you for as long as you live, until your death, and even after your death, if you leave dependents behind, those dependents can still get benefit. So a lot of people ask questions about my money and what happens to my money when I die, and
right.
The concept of solidarity is at the heart of every social security or national insurance system, that we are all in this thing together, all of us making contributions so that all of us can benefit at some point. So if I happen to have contributed for many years, and I was blessed with good health, I never got much sick leave and whatever, and God forbid I die in an accident, I did make it to pensionable age, the contributions I have made over the years stays in the pool to support the other members of the pool who are there, who will be required to benefit. So some of us contribute much and get little, some of us contribute little and get much. But that is how it works. Once we participate in the creation of the pool and in the maintenance of the pool, when we have a need, the pool is supposed to take care of us, and the pool will take care of us once we meet the qualifying conditions.
Mm-hmm. Okay, 5 minutes before 10, we're here talking social security. I want to get into the student loan facility. That was part of our discussion. We were here about roughly about a month ago talking about that, Mr. Etienne. Before we get into that, we have a call on the line. Can we take this call? Mm-hmm. Yes. Hello, good morning, you're live. Okay, we lost that caller. Yes, student loan facility. Let's look at the eligibility of that again. Who is eligible, who can apply, and what are we offering at or from the Dominica Social Security in that respect?
To say that the student loan facility is a means of investment for the system, where we on-lend money to persons who need to pursue tertiary level education on which we earn interest. And to say that investments is a critical aspect of any social security system, because the contributions that you're collecting from working persons, by the mere percentage at which you are collecting those contributions, vis-a-vis the percentage at which you promise to pay them benefits, the contributions alone are not sufficient to sustain the benefit payment. So investments are critical. You must invest to earn returns so that you can grow reserves even, and to kind of have what you would look like a revolving fund, that you always have money in the pool to pay people benefits as and when they become entitled to it. So the student loan facility has been in place from 2014. This particular one, where the board allocated a certain amount of money for the purpose of on-lending to persons who wish to pursue tertiary level education. And the persons who can qualify are either contributors or children of contributors. Because our program is a contributory one, people are contributing part of their salaries into the system. And so it is those contributions that make up the main source of income to the system. So when we use income that we receive from people who are contributing, we should only use it for the benefit of those who are contributing. And so the people who can apply for those student loans are contributors themselves and or their children. So you as a contributor can apply for a student loan for yourself, or you can apply for a student loan for your child. If your child herself is already employed and contributing, they can apply in their own right and qualify once they meet the qualifying condition. To qualify, we need to have, first of all, the student has to have a letter of acceptance from the institution with which they're going to pursue their studies. They have to provide us with a schedule of fees, an invoice to say how much tuition, how much living expenses they have to pay for their course of study. We need 2 testimonials of good character, saying that you as a person is a person of good character who will honor your commitments, because we cannot take people's money, give it to you to pursue studies, and we have no guarantee that you're going to pay it back. So we want to know that you are of good character, that you will honor your obligation. The institution with which you are enrolled must be an accredited institution, so the Ministry of Education has to confirm by letter that this particular institution with which you're enrolled is accredited, because it would make little sense for you to pursue a course of study with some, maybe a fly-by-night institution that make you register online and you follow something, and they might give you some document at the end of the day, but it will not be able to hold water, because when you check, the institution is not a bona fide institution, so the document that you would get, the degree, the diploma, the certificate, would be of no value to you. So we need to ensure that the institution with which you're enrolled is accredited, and the Ministry of Education in Dominica can provide evidence of that. For amounts of $20,000 and below, the security that we would require would be 2 guarantors in good financial standing, and the guarantor can be your parent, your spouse, a sibling, an aunt or an uncle. And if you yourself are working, you can be a guarantor, and you would just need one other guarantor. For amounts in excess of $20,000, we would require a certificate of title that is free, unencumbered. No other institution has a lien on that certificate of title. And the value of the security has to be at least 1 1/5 times the amount of the loan, for obvious reasons. If you have a property that is pledged as security and you have to sell the property to recover your money, the sale might take a while. In a forced sale situation, you may not be able to recover the full value of the loan. So if the value of the security is exactly the value of the loan, and you have to force sell that security, you may not recover the full value of the loan. So we want it to be at least 1 1/5 times, so that give and take the amount of the reduction that you would have to take in the value at which you will be able to sell it, you still might be able to recover your full amount of the loan that would have been on lent initially. We need 2 recent valuations of the property that is the subject of the COT being pledged as security. We need credit reports from the guarantors, from the financial institutions with which they have dealings. They will sign the forms and we will send it to the various institutions where they have financial dealings, and they will advise us of their credit rating. And we also require them to sign standing orders, so that at some point we can effect those standing orders, so that the student who is studying, upon completion of his or her studies, will be required to service the loan. So they sign standing orders upfront, and when they get a job at DBS, at ministry, when they come back from studying, we just send it to that particular employer for them to pay the contribution, for them to pay the installment on the loan. Somebody needs to service the interest payments while the student is studying. Because if you do not service the interest payments, the interest gets added to the loan and you get charged interest on interest. You have to capitalize the interest that's not paid as part of the loan and charge interest on interest. So it's always easier for you to service the interest payments as you go along. For persons who study locally, who are here on island, who are studying online or maybe studying with the UE Global Campus, they are working, they are here, they are present, they're getting a salary. They can in fact service the loan as they study by paying both principal and interest. But at least we require the interest payments to be paid while the person is studying. And we also require them to be enrolled in a group life insurance plan that we have, that all the borrowers pay a very small premium to be part of a life insurance pool, so that if something happens to that person, we can get the proceeds of the insurance to kind of repay the loan. So these are among the requirements.
Have people been coming forward since you launched this?
Yes, we always use this opportunity, this moment, because we are in transition, graduation season. People are looking at the opportunities for them to advance their studies at the state college, at UE, going overseas, doing whatever. So we try to heighten the awareness around now, because it is graduation season, people looking to transition from high school to college, from college to university, and so on.
And you're hoping that these people can come back and contribute.
Yes, indeed. Yes, indeed. Because what we're doing is by facilitating them in acquiring those higher education, making themselves more marketable so they can come back and command good jobs and get good salaries and pay contributions. That will strengthen the system in the long run.
Okay. So as Mr. Jean-Jacques, as Mr. Etienne said, investment is a critical aspect of social security system, in our case at the Dominica Social Security, and we're looking specifically at the student loan facility and other areas of investment. Can you give us any info as to what the return on investment based on your findings over the years has been like? You may not want to divulge specifics, but overall, the success rate of the return on investment through schemes like these. Yeah. Any one of you could take a knock at it. Has it been worth it?
Yes. As far as we know, all of the investments that we've made have always been good. It's just that in the prevailing climate now, where the opportunities are limited, our overall return on investment might not be where we want it to be, and the overall rate would be like an average of the different instruments that we have in our portfolio. They attract different rates of interest, but when you do an average, it might work out to about 4%.
About 4%.
About 4%.
Okay.
Net of inflation. Is that real or? Because with the rate of inflation, it kind of it erodes into the rate of return that you enjoy. So on average, it works out to about 4%. Ideally, we would probably want, I don't know if the actuary has recommended a particular rate. In the past, they used to recommend that what we should be aiming for is a certain, let's say, 5-point-something%. But those rates are not available in the current climate.
Recommendations from Mr. Jean-Jacques as an analyst, again, based on your findings. You mentioned earlier you look at, as we just touched on, inflation, demographics, economics these days. We are seeing, although we still have a high percentage, I guess, per capita of centenarians on island, and people are living long, but we are seeing a lot of deaths, among a lot of young people these days, So what are the overall recommendations and projections moving forward as far as your findings, within your work would be, Mr. Jean-Jacques?
Well, the actuary generally makes recommendations as to what should be done to ensure the long-term sustainability of the fund. Now, we're not controlling the number of births and deaths of people. We can't control what sort of economic situation we end up in as a social security system, But what we do have control over is the policies that we implement. So, for example, we had the gradual increase in contribution rates. We had the change in pensionable age. Those are the sort of recommendations that we as an institution have control over and can implement to ensure the long-term sustainability of the fund. And there are other recommendations that will be made by the actuary, and it's up to us to review them and see which one is the most palatable, if you will, for the general public. The one that causes the least amount of burden, that feels the most fair and equitable to all citizens, and gives us the best return, the best results at the end.
Yeah. Is it too early or premature to say or project that there would be a continued increase in the contribution rate, if inflation and other factors? Is it premature to?
It might be premature, but they might be indicating that given the prevailing, the package of benefits that we offer, it's defined in the law. And because it might be difficult to shortchange people or to change the benefits, make it less favorable. And generally, you try not to make things worse for people when you're making changes. You want to at least keep it where it is or make it better. So to the extent that I lost my train of thought.
Yeah. Well, I like what you said, in making change, you try to make things better.
So you're trying to make things better. But what they're saying is because it will be more difficult for you to tell people they're going to qualify for less benefit, you have to try to address the financing side. And it may be difficult, but it may be necessary for you to make those changes and make those changes early enough in the system that you do not have to wait too late, where you would have to then make more drastic changes. So people make noise and say, why we paying the increased contributions? Why we increase the pensionable age? Why? And the answer should be, why not? If you don't, and people think about themselves alone, how I am affected by these changes without thinking of the bigger picture. As I said, the system is supposed to be there in perpetuity to take care of everybody. And solidarity is at the heart of the system. All of us in this together. So I mustn't be concerned about how much I get from it, and I'm not concerned about how much Marcus will get, how much you will get. I have to ensure that I get mine, and I should be happy that you get yours and Marcus. And even our unborn children will get theirs when their time comes. So I think our people need to get to the point where they understand how the system operates, and to ensure that all of us have a part to play in ensuring the sustainability of the system and its relevance for the benefit of all of us. Yeah. Obviously, we will benefit from to varying degrees, but all of us have access to the benefits. It is when the situation happens to us that is when the system has to pay us a cash benefit, not sooner, not later. So if I never get sick, well, I'm not a woman to be pregnant, I never get an injury on the job, I never get sickness benefit, I've been paying contributions for 40-something years, I'm not a woman, I never got maternity benefit, I'm not 65 yet, whatever. So I may not have benefited much from the system up to now. But should something happen to me tomorrow, next week, next month, next year, I don't know what can happen, when and how. I can access the very same benefits that the other people have been enjoying for so long.
Yeah.
And I mustn't begrudge the person who has been enjoying the benefit, because if my situation is such that I become like that person tomorrow because I've made those contributions, I will be able to access the same benefits. No, I will not necessarily benefit to the same extent as another person because my situation may be different. But I shouldn't be concerned about trying to get all I can from the system and deprive him of his and deprive you of yours. All of us have to get our share when the time comes. But it's only when we have the need that this will happen.
Payment of benefits over the years, say 5 years, 10 years, fluctuating, increase, on a rise?
Increasing. Because as we said, we have an aging population, and the most costly of all the benefits we pay is the one that is called age pension that you pay to people who have attained the pensionable age. Almost 90% of our benefits go towards those persons.
90%?
Almost 90% of our benefits go towards the payment of pensions to persons who are pensionable. And that is a lifetime pension. It has to be paid until the death of those persons.
Yeah.
And even beyond their death, if they die and leave dependents behind, those dependents still get part of what they were getting.
Wow. Marcus or Augustus, do we feel, in ensuring sustainability that, and again, looking at investment opportunities, that it may be necessary to get involved in other investment schemes.
Other investment,
such as, well, you have the loan facility and other areas for investment.
Okay.
You know,
so our investment portfolio currently has bonds, government bonds, government bonds. We have loans, not just our student loans. We have loans that we make to Aid Bank, National Bank, credit unions, Dawasco, the government of Dominica, like for the construction of police station in Laplin and Calibishi most recently.
So the loans to statutory
boards, yes. Loans are all of any loans we make, we get interest on it, so it's investments.
Right.
We have some equity. We have equity in National Bank, Aid Bank, Domlec.
Okay.
And we have some bonds in the regional in the OECS region. We have some real estate, real property. We have 2 buildings in Roseau being rented to give us good returns. But we also have lands in Warner and in Portsmouth area. Lands that were given to Social Security in lieu of past due contributions, and which really represent people's contributions that is tied in land that you eventually have to liquidate to be able to get money to pay them their benefits when they need to get their benefits.
Wow.
So that for now is what our investment portfolio comprises of. The one thing that we need to start doing, we've been advised, even by the last actuary, that we need to diversify our portfolio somewhat, because it's like we have all of our investment eggs in one basket. Most of our investments are in Dominica, or let's say within the OECS region. We use the same currency, we're exposed to the same environmental factors.
And currency risk. So to diversify our risk a bit, we need to expose a small percentage of our investments to the international market. Yes, a lot of things happen there, a lot of fluctuations, volatility in the international market. But when you make those investments, because our obligations are into the long-term future, if you make an international investment, you're not making it today for today. So when you make the investment, you may need to, even if there are fluctuations, you may not need to react to the fluctuations, because when it go down, it might go back up. If you want to react when it go down, you want to pull out your investment, you might be losing. But you let it ride over the fluctuation, and over the long run, you might be able to see better. So the actuaries recommend that we need to diversify our risk and start pursuing some level of international investment. We've been toiling with the idea for a while. We actually were trying to pursue it as a region where we could pool resources, the monies to invest as well as our expertise, so that as regional social security systems, we can participate in the international market. But that has not materialized to the extent or as quickly as we thought it would. And some of our sister institutions have gone ahead and invested internationally on their own. So we ourselves need to expose our investments, albeit a small portion, to the international market initially, and over time maybe grow on it.
Okay, very interesting. We're talking Social Security. Let's take in a few words. The toll-free line made possible compliments Flo. Don't be shy. Feel free to give us a call at 1-800-327. You could call us 448-3284 with your contributions or questions. In the meantime,
you asked for it and you got it. A quicker way to pay your bills online. It's fast, secure, and easy to use. No registration, no additional fees. Flow is now offering FastPay, an online service that allows you to settle your bills in less than 2 minutes. Need a receipt? FastPay will send it to your email immediately. Use FastPay now for convenience, safety, and efficiency at discoverflow.co/fastpay.
Flow FastPay. 2 minutes and you're on your way. Flow FastPay.
Flow is keeping you connected.
and in diversifying the investment portfolio, looking at the telecommunications sector, man, we say it, looking at the telecoms company, Flow, and these guys.
In what sense?
Well, in terms of diversifying your investment portfolio, as I just played the ad from Flow FastPay.
Well, interestingly, we used to own the former mapping.
Used to.
We used to, and that was eventually bought over by Flow. And right now, I think mapping has been decimated. I mean, whatever. I don't know what aspect of mapping operations are still part of Flow's operations. So sometime in the past we had purchased the mapping business, and we eventually decided to mapping. We were in collaboration with a Florida-based company, WRB. We're in the business of whatever, and we eventually sold it. I suppose every investment decision that we make has to be based on the best available information at the time we make an investment. So any investment that we pursue, we have to analyze it. We have to do due diligence on the people, and we have to get no objection from our principals, the minister responsible for social security, for us to make certain investments. So when we make an investment, it is not something that is taken lightly. Recognizing that we have to preserve the capital, one of our principles for investing. When we make an investment, we may not be able to always receive the level of interest that we want, but we cannot afford to lose the principal amount that we invest initially, because that is people's contributions that we are taking and making the investment with, and we cannot afford to lose those.
Yeah, Mr. Marcus, what else you may want to share with us with regards to your reviews as an actuary? What some other key areas you may want to highlight here on the program, even before we wrap in the next few minutes?
Well, I would like to paint an analogy for what the actuarial review is, I guess.
Sure.
Like, you could think of it almost like a doctor visit, a doctor checkup, where you may go in one day and they would, let's say, check your blood pressure and notice it's slightly higher than what it was the last time you came in. And the idea is that you make small changes now to prevent bigger changes later down the road. So if you notice your pressure is slightly elevated, your doctor may recommend that you cut out on the salty snacks before bed, you go take a little jog now and then, or engage in some physical activity. The actuary does the same thing in that sense, where they see whether or not we're on track to make the promises that we're supposed to be making in terms of you getting your benefits later down when you're pensionable age. And if we're not on track, they make these small recommendations so that we don't have to take drastic recommendations later on, or any large increases in contribution rates. So ultimately, the actual review, it's not anything unusual. We have it every 3 years. Is to make sure that we stay on track throughout the years to ensure the benefits that we promise.
And the next review will be based on the years 2022 to 25,
2024, 25, 26.
24, 25, 26.
Yeah, because the last one was done as at 2023, so 24, 25, 26. At the end of 2026, the next review will be due. And to say that when they make those recommendations and projections, they are saying that the system should be okay for the next 60-year horizon. 60 years from 2023, what will be the state of the system in that time? When they come in 2026, they will do it for another 60 years. Well, not another. You're not adding 60 years to the previous 60 years. You're looking at 60 years from the date of the review, that the system will be sustainable over that horizon. So, as Mr. Jean-Jacques said, we're making small changes as we go along to ensure long-term sustainability. If you fail to make small changes, you may have to make bigger, more drastic changes when things are looking like they're heading downhill. So it is always better for us to take heed of those recommendations and make it, and implement them as early as possible, so that you do not end up making more drastic changes later. We want to say how we are grateful for the changes we made effective 2012, the reform measures that we implemented beginning in 2012 that saw the increase in the pensionable age from 60 to 65 where it is now, the 0.25% increase in the contribution rate per year. We're going to take 20 years to achieve a 5% increase overall. Thankfully, we are closer there now than we were, We have a few more years to go, but it's like every year when we remind people that this is happening, they up in arms again. But if we, in hindsight, we actually now feeling we probably should have bitten the bullet and taken the increases faster, do a 1%, 1%, or whatever, by now it would have been done away with. But we said no, we want to minimize the impact on our contributors. Let us settle for a 0.25% increase per year. So after 20 years, we will realize a 5% increase. But every time we remind them that it is changing in January, people up in arms as if it's the first time. So going forward, and in fact, we've recommended or we've advised our sister systems, when you have to implement those changes, bite the bullet as much as possible, because people get a little weary, people get a little tired.
Wow.
But I would like to say that if we did not do that, the actuaries have all indicated since we implemented those changes that they've enhanced the sustainability of the system somewhat. Yes. Because before those changes were made, they were saying that our reserves probably would run out earlier. We may need to start charging people the full cost of the benefits and all those kind of things. But by having made those changes, it has delayed the time when these things will become necessary. And going forward, if we still fail to make changes that they will recommend, we may get to the point where we have to make those drastic changes, where people will have to pay the actual cost of the benefit at a particular point in time. Pay it as we get it, we pay to the beneficiaries, and there is no reserve being built. As of now, we have reserves that were built historically, reserves that we continue to grow, because whenever we have a surplus every year, after we take account of all our expenses, benefits as well as admin, the surplus gets added to the reserve, so we have monies going forward. But the time may come when those reserves will be depleted, or the growth in those reserves will be diminishing. So, but you will get to a point where if we don't make changes, people will have to pay the actual cost of the benefit as you go. So you collect the contributions today, you pay it in benefits, so you have no extra for tomorrow. You collect it today, you pay it today, tomorrow it takes care of itself, next tomorrow it takes care of itself, that kind of thing. But the further along that can happen, the better the system is. But that is something that will happen at some point in the life of the system.
Yeah. As you speak of life, yesterday on another program, economist and businessman McAfee Marie, I think he projected or suggested that in the next few decades, there'll be no one in Dominica. I don't know if it was an exaggeration to really stress or emphasize his point, or how serious he was, but do you look at things that way based on trends and probably factor these things into
the population dynamics? Yes. If things continue as they are, we're not realizing population growth. There might come a time when we will not have population, or there might come a time when we haven't got young people available to work to support the contribution payments to pay us our pensions when our time comes here. Mark has been singing that song for a while.
Yeah.
Yes. He seemed to have an appreciation for the effect of population growth or lack thereof on economic development and stuff like that. And to an extent, there's an appreciation of the impact on social security as well, because social security depends on population to pay contributions, but also has to service pension payments to population when they get of age, that kind of thing.
How are the rates, not numbers, comparable or different in other sister territories now, based on the data you have?
What rate are you talking about?
Contribution rate, benefits, etc.
Okay.
From what you know.
Comparable.
Yeah.
Comparable, because the last actuary was comparing where we've been, where we are, and where we're heading to. And all the systems are heading to about the same position. Some of them have been at a level for an extended period of time, but because they probably had increased their contributions earlier, the amount that they at is sufficient to sustain them for a while going forward. But the others of us are moving towards about the same point, about 15.75, about 16% thereabout. Only one might be 20-something percent.
Yes.
Yeah, only one might be about 20-something percent. In terms of our benefit levels, comparable as well. Although ILO has told us that our replacement rate in terms of the percentage of pension that we offer, it's better than ILO's minimum standard. ILO minimum standard, I think, is 45 or 50%. We're going up to 60%. But not everybody will get 60%.
Okay.
It depends on how long you would have contributed for. The percentage of your earnings you get as your pension is a function of how long you contributed for.
Yeah.
But some of us, if we work long enough, like people like you and I who've been in the system for a while, by the time we attain our 65th birthday, we would qualify for the maximum. The earlier set of pensioners would not have, because The system had not been there long enough for them to contribute for that length of time. The system is going to be 50 years next year, and you need 40 years contribution to the system to qualify for maximum at 60%.
Wow. Okay, as we wrap, well, educational, informative as usual. Our analyst here, actuarial analyst, Mr. Marcus Jean-Jacques. Your closing remarks, anything else you probably want to share with us as we close this very important and informative engagement?
I would say that Social Security is one of the best things you can invest in, because unlike, you make several payments to your car, that's a form of insurance. You may never get into accidents and that money just disappears. But when you compare that to Social Security, you almost always get something back. You get either a pension if you survive long enough, or your dependents or survivors, they get something, or you might fall sick and you'll get something there. There are several provisions that we have, so it's good.
Yeah, and there
according to DICE.
Yeah, it's good. And contrary to, because we all know what happens with premiums when we claim, on insurance, if we have an accident, whatever the case is. But with Social Security, no, if we want to say penalties, so just like that. So it's good, as King Dai says.
It's good. And it's to appreciate the solidarity principle that's at work. That it is something that the architects put together to ensure that we all paying when we are able to, and we all are able to draw out some benefit when we have difficulty receiving our salaries. And those difficulties arise because of certain risks that we're exposed to. And when those risks affect us, it is not our fault. By participating in those social security programs, we have access to income protection. Our income will be protected, that we have a source of income when we cannot access our salaries because we're suffering from a particular situation, which is consistent with some of the risks that we covered against under Social Security. So as Mr. Jajak said, Social Security is probably the best investment because the returns that you get far outweigh the amount that you put in. Because the benefits we promise you, the benefits we actually pay you, is not necessarily limited to the contributions you had paid in. You paid contributions as a percentage of your salary. At the moment, the contribution rate is 14.5%, 15%. We're promising you in the short term 60% of your salary when you're sick, when you're on maternity leave, if you get into an accident. And in the long term, we're promising you a pension of between 30 and 60%. So for me to pay one person sickness benefit, I will need to collect contributions from 4 persons. And you can see the correlation why the actuary have to make recommendations to make changes. Because if I need 4 people to pay me 15% each to pay one person 60%, if I have 2 people working, all I'm going to have is 30% when I need to pay the other person 60%. Where the other 30% coming from? From investments. So if we understand how the system works, we will probably be a little more supportive, more cooperative, and more compliant as employers who pay contributions, self-employed persons who pay for themselves, employees themselves not to take advantage of the system, voluntary contributors, and beneficiaries not to try to get more from the system than you're supposed to get. If your situation has changed and you no longer qualify, you're no longer eligible, let us know so that we don't pay you extra. You were sick and you get better, you go back to work. Let us know so we don't pay you sickness and you get salary and sickness. You were deemed to be incapable of work for a while, your situation has improved, you can go back to work. It's good for you to go back to work because when you work, you have access to 100% of your salary. When you are not at work, the best we can offer you is a percentage of your salary. And so, but you contribute towards those benefits, and we do have difficulty making benefit payments. People have concern about all that sickness while you're paying when we have the flu, when we had COVID. Yes, if it didn't happen, or we didn't have to pay, the money would be there. But that's part of what you're contributing towards.
Yeah.
But what you mustn't do is to not abuse the system and go and fake sickness just to get money when you're not really sick. And although we're not in a position to say that if a medical doctor issues a certificate, we honor it for the most part. But we know Dominica is a small place. Some people Some people just have to have a beef with a colleague at work and they just send a medical. They're not really sick, they send a medical.
Yeah.
They will get paid because we know we don't always question. But it doesn't mean we cannot question the validity of those claims. We as Social Security can do it, the employer can do it as well. Okay? So the important thing is to recognize that this is there for you when you have a need. Yeah. If you haven't got a need, you're not going to miss it. If you do not live long to enjoy it, you're not going to be there. You're not going to have a need. You're not going to miss it. But trust me, if you are here and you're here as long as we have a history of being here for, you mentioned earlier that we have the largest number of centenarians per capita. If we are among those people who live long, we will need all of what Social Security promises us and even more. So imagine not even having what Social Security promises you, much less. So make sure you do what you have to do while you have the chance so that you can at least avail yourself of the protection that we are here to provide for you.
Very good. And you have made good on your promises. For sure, that's good. We want to commend you guys at the DSS for that. But I'm sure you'd be happy still that we can play our part and do what we have to do to...
Indeed, yes. Yeah, it will make our work easier for us and enable us to better